Hey everybody, it's Seth and Paul for Everything Money Channel. Thanks for joining us today. We're going to look at Roku as a company and as a stock buy or avoid. Paul's going to give you the ins and outs about Roku. You are going to learn the financials, not the hype. We're going to follow the math and see what they're doing with their revenue, their income, the number of shares they have. All of this we're going to go over right now, and you're going to learn from your Uncle Paul whether this is Roku is a great company, an average company, an avoid company. They have some interesting things, Paul. So they bought in the last few weeks. They gained access to Quibi catalog. Apparently, they purchased like 75 new shows. People are looking on the up and up. Analysts on other channels are upping their price target. What do you know about this company, Paul?
So you use Roku.
I do not.
Or use Apple TV.
That's right. What do you use, Roku?
I have Roku and Apple TV.
Okay, but go on.
I like Roku more than Apple TV.
Oh, okay.
But I'm also switching over to Apple TV, but why? I'm switching over to Apple TV because of all the access to my phone, putting everything together, right?
I see, yeah. I do love that.
Our Mexico homes use Roku. I've always been a big fan of Roku. So I'm not biased either way. I'm very impressed with their numbers from a growth standpoint. And they just started making profit. So let's look into that. But I want to make note of one thing before we go. In March, look at this price right here. What was this price right here, Uncle Seth?
Oh my Lord, is that like $40?
$63, and now they're at $436.
Holy moly!
I mean, it's up 7 times less than 7 times, over 6 times in the last freaking 9 months.
So I assume a lot of other channels out there are just saying we have to buy this because it's just going to keep going in this trend, right? We're going to 10x our money, Paul.
Correct, and I'm sure from a technical standpoint, when you look at charts like this. You look at that saying there's a channel going up like this. It's at the top of this channel here. If it breaks out, it could go even higher. So these are the things that people look at from a momentum standpoint. But from a fundamental standpoint, we're not looking at any of that, even though we'll look at that later. But right now, we care about how much revenue, how much profit, and what are you paying to get that.
What is the market cap of this company?
So this is a big market cap company, guys. $55 billion. This is big. PE ratio is negative.
Uh-oh.
Over the last 12 months. They've lost $100 million on $1.5 billion. So guys, keep in mind this. The revenue is only $1.5 billion and the market cap's 55. That's a huge, that's 35 times price to sales. We talk about this every once in a while. Keep in mind, a company like GM is 0.3 times sales. This is 35. So this is over 100 times more than GM. Now GM is one of the lower numbers, but it's taking the price of the company divided by the sales of the company. That's a big, big number. It already tells me this is very, very expensive. Does that mean it's a no? It does not, but this is very, very expensive. So far we have 1x with PE ratio.
What is their profit margin? We want this above 10%, Paul.
They just made a profit last quarter of 2.87%, so this is still an X. But again, for the year, they still have a loss. The one thing I do like, though, Uncle Seth, there's something I really like a lot, and it's big for tech companies.
Go on.
Their gross margin is very large, 47.5%. That means for every extra dollar they bring in revenue, 47 cents will go to profit. So as they grow very quickly, they're going to add a lot more money to that bottom line. So this is a very big plus. This is where sometimes you don't have to care as much about the revenue and profit, as much about profit today, as long as you can see the path to very big profit in the future. Because remember, a stock and a company are worth the present value of all future cash flow. So even if it's not making money today, as long as it's going to make a lot of money in the future, it's going to be worth a lot more today. So when people accuse me of saying, oh, you have to see profit, I like to see profit. But as long as I can buy a money-losing company for a reasonable price, I'm okay with that. I think we're going to see this might not be one of those.
Pillar number 3 is revenue growth over the past 5 years. We want the revenue growth.
What do you think the revenue growth is going to be?
Up, I would assume.
It's going to be huge, I'm sure.
Yes.
So look at this, guys. They have 5 years of data. 320 million to 1.13 billion. This is a huge. They've almost quadrupled in the last 5 years.
How about profit growth, Paul?
Well, I'm sure this is going to be a check because I think they're going to lose less money, but we'll see. Profit growth, negative 40 million to negative 60 million. That's an X.
Oh,
They've actually lost more money, but a lot more revenue. So when they had 307 million, they did 40 million in loss. Now they have 1.13 billion, and they only have a $16 million loss. So relative to revenue, it is a lot better.
How about shares outstanding? Pillar number 5. We want this going down.
And of course, like expected, it is not.
Oh boy.
85.7 to 115, another X. So what this means, guys, is they are diluting you as an owner.
Uh-oh.
So let's say there were 10 shares to start, and you go to one of them. You would own 10% of the company, right? 1 out of 10 shares. Now let's say they want to make an acquisition. They issue 2 more shares to acquire a company. They go to 12 shares. You still own 1. You still own your 1 share. Now you own 8.33% of the company. 1 divided by 12. So you still own the 1 share, but now you went from 10% to 8.33. Let's go the other way. Let's say it started with 12 shares. You owned 1, 8.33%. They bought 2 shares off the market to buy them back. Now there's only 10 shares. You now own 10%. That's the benefit of seeing shares decrease from 12 to 10. Does that make sense?
Yeah.
I think this is pretty good. I should do this more often.
Yeah, the back and forth is nice.
Yeah, it's really nice.
Make sure you guys are tickling the thumbs up. We really appreciate it. Obviously, this entire studio, this whole network, that board, Paul, is incredible. That was like an almost we didn't buy that, and you pulled the trigger on that thing.
Yeah, I was like, listen, this is stupid. We need this.
And people love this board because anyway. So
I get a lot of comments there. People going, hey, where's that board from? I'm like, go to Amazon. I bought it off Amazon.
Yeah, but no one's got like $5K sitting around.
It wasn't $5K. It was $2,500.
Oh, okay. Well, make sure you guys are tickling that thumbs up. We love you, Paul. Go down to current assets. Pillar number 6 is current assets greater than current liabilities, baby.
So current assets are the cash on hand, and they have $1.5 billion of cash on hand essentially. Current liabilities, $465 million. Nice. Even better. Their total liabilities of the company is $867 million. Remember, they had $1.5 billion in cash. Total debt is $887 million. They can pay off all the debt of their company, all the debt there with their cash on hand. This is this is multiple check marks here. This is beyond belief, check marks. This is perfect. Now, if the market cap wasn't so high, you'd take $700 million off of their market cap because their cash less their total liabilities is so much, which you still should anyhow, but it doesn't change the needle much because the market cap's $55 billion and their net cash position is only $700 million, which is 1.5% of it. So it's not a big deal. But in a normal situation, let's say this is a company that was worth $3 billion and you had $700 million in extra cash after all debt. You're now taking the value to $2.3 billion. That's a big difference.
That would be your new adjusted market cap.
Correct. Now here it was like 50, let's say it's $55 billion. Now it's going down
54.3
to $54.3 billion.
Not much of a change.
Yeah, no one really cares. But that's an important aspect. It's it's hard for companies to go under when they have more cash than debt on hand.
Pillar number 7 is free cash flow, the granddaddy of them all. Paul, you like looking at free cash flow to determine what market cap you value this company at. So let's look at it.
Let me tell you this is going to be a doozy. You know what? So they lost $37 million, and this time they lost $71 million. So it's an X again, and it's a bunch of negative cash flow. It's not going to have a ratio. So unfortunately, guys, we can't look at free cash flow. It's 2 X's for the last 2 items because over the last 5 years, their overall free cash flow has been negative. I think. I just did a quick scan of it, and it looks pretty negative. So negative, negative, positive, negative, negative. Yep, it's negative because the positive year wasn't that good. So, guys.
But it's growing, Paul. The numbers are astronomical in terms of users going up 36% per year.
So, if you want to look, let's look at the positives they had. As Seth just said, some of the positives they had. Let's go to a screen that we can make blank. Some of the positives they had. Users. Okay. So 2018, 2019, 2020. Now I'm going to impress my group over here when I show them that I remember the numbers. 29.1 million users, 39.6 million users, and 51.2 million users.
That's true.
Okay? This is huge growth. This is 40% growth. I don't think this is 40%, but it's a big number here. This is not 40, but it's like 30% growth. The point is, though, these are huge numbers of growth. I don't know how Roku makes money because I haven't looked at their 10K in detail, and people are going to say, remember, we're doing a 500-foot view here. I haven't looked in full detail. We don't pay for Roku, do we? We just buy the device. We don't actually pay a monthly fee. Yeah, we just buy the device. So I like the monthly fee recurring. I don't know how they're making more money. Maybe the people pay them to get on to Roku. Maybe like channels and other people pay them. Hey, NBC wants to have a channel on there. They're going to pay 20 cents per person or 20%, whatever it is. The bottom line is the user growth is growing fast. Major positive. The other thing I like about them, if you look at their 10K, which I literally scanned their 10K before this video to find this information. But if you look at their 10K, the thing I like about them, look at this research and development expense. 2018, 2019, 170 million to 265 million. I like that a lot. They're spending more. I like it when companies spend more on research and development and growth. The next number, sales and marketing, 103 million to 179 million. Big jumps, 55%, 74%. They're being serious about getting big. And I like that because they have big competition. Apple is big competition. My biggest concern would be Apple for this company. Would it not be your biggest concern?
Well, Apple has moved into making its own content as well.
Yeah.
Hell, they made that this Tom Hanks movie, the World War II battleship movie. It was freaking incredible. I don't even think the world even knows about it. I've watched it 2 or 3 times on Apple. So maybe Roku can grow even more if they start making their own shows like Netflix.
But at what point do we get saturated with Netflix, Disney Plus? I mean, HBO Go, Showtime. All these companies have their own streaming service, and everybody is $8, $9, $10 a month. I mean, maybe 10 people. I mean, maybe the whole point of it is, hey, listen, if you're going to pay $100 a month for cable, just get 10 of these.
Yeah.
10 of these streaming services, and it's $100 a month, but you get thousands and thousands and thousands of movies and shows. Could be the case.
Yeah, I mean, I have the Netflix, I have the Apple, and I have Prime Video, and I don't actually say I watch that much TV. So I mean, it's.
And that's the funny part. I have a group chat with a bunch of guys who are younger, and 20% of the group chat is talking about what shows they're watching.
Yeah. Because
they love them so much. So I think there's a lot of pluses for Roku. I will say at $55 billion, though, that's a no-go for me. That's a no-go for
currently
me.
Avoid, way too high.
Yeah. Now, would I bought it at $60 a share? I think I would have because of the fact that they have $1.5 billion in revenue, and if they can.
Well, Paul, it's 430 a share. I mean, obviously, now it's fairly obvious you would have bought it.
Well, not fairly obvious. I might look at Tesla. I'm not saying Tesla is fairly obvious at 150 or 200 a share. I actually still think it's overpriced.
Mm-hmm.
Do you follow what I'm saying?
Yeah.
But here, 150 billion in revenue, if they can pull up 15% to the bottom line, that's 225 with fast growth of 20% a year. I mean, I think then paying. I don't know. It's an avoid for me right now because this stock price. Is it going gangbusters right now? Absolutely. Let's look at their momentum. It is growing gangbusters, but I want to make sure. Oh my gosh, look at this. It crossed over right here. Right here.
So this is the 200-day moving average crossing over the 300.
The 200-day in blue, 300-day in orange. We want when the blue goes over the orange, you buy. When it goes below, you sell. It crossed over at around 200 a share, roughly. And now it's at 430 or whatever it's at.
434.
So it's insane right now. This is parabolic. I would expect a pullback of some point at some time. I would just avoid the company right now at this time. I think because of the fact that the valuation's high. And I still think Apple is more likely to win that battle over devices. You know what I mean? I still think Roku is great. We use Roku in Mexico. We've had a great experience with it. And I'm just going to, when I move to my new house, I'm switching to all Apple TV.
If this analysis resonates with you, make sure you like the video, thumbs up, of course, and make sure you subscribe. As always, you can join our Patreon. The description look in the description below for our link. Paul, we have 370 patron members. We love them. We interact with them on a daily basis. We do Patreon-only videos just for you. And, of course, Paul, I knew where you're going with this.
The software, guys. You saw this data here. The most common question I get is, where'd you get the data? I pay $500 a month for this data. I just started paying $2,500 a month to be able to provide you with the data for $8 a month. If you join our Patreon at any level, $8, $25, or $100, you will get this for free when it's available. That's the reason why I'm offering it at a discount right now, is because the website is still in production. You'll get the 8 pillars will be done automatically for you on the top 3,500 companies in the US, and you'll get all the financial data for those top 3,500 companies. You can do your own research, stay along with us, and as time goes on, I'll be adding more and more, and the Patreon will get more expensive. Get in it now. I think it's absolutely wonderful. It has been very successful for us. We had 20 Patreons. We had 0 patrons in November. We have 370 now, and we're growing like gangbusters because in November, I think we had 2,000 subscribers at the beginning of November. Now we have 11,400 this month.
And if you become a patron this year, two of you will be driving home a brand new Tesla Model 3 right out of Paul's wallet. He's giving away 2 Teslas this year, not to subscribers, to our patrons. So
not out of Seth's wallet, not out of Don's wallet, out of my personal wallet. I will be buying 2 Tesla Model 3s for 2 lucky winners at 50,000 and 100,000 subscribers.
We love you. Thanks for watching. Join the Patreon, get your Model 3 cooking, and we'll race them down the road. We love you. Thanks for following, and thanks, Paul, for that analysis. Love you guys.